What's up, Theta Gang? Today we're going to be learning about call options. There are two different types of options contracts, call options and put options, and either of these can be bought or sold. So you can buy a call option or sell a call option, buy a put option or sell a put option. In this video we're going to be covering exclusively call options, but we have other videos that cover put options, so make sure you check those out. So what is a call option? A call option is a contract between two parties, the buyer and the seller, where the buyer has the option to buy a specific stock at a specific strike price on or before a specific time from the seller. The buyer pays a premium for this privilege. The seller has an obligation to sell that specific stock at the strike price at the expiration date. If this seems a bit difficult to understand, I have a real life example that really helped me grasp the concept when I was first learning options. But if you think it'll help, go ahead and press the J key a couple times, rewind and listen to that definition again until it clicks. Now in this example below, we've got Bob and Joe. Bob is selling his house, which is worth $100,000, and Joe is in the market for a house, but he doesn't want to buy it right now because he's unsure if the housing market will go up or down. He's betting on it going up in the next few months, but he doesn't want to risk $100,000 buying the house. So Joe makes a deal with Bob. Joe tells Bob that he's not ready to buy the house yet, but if Bob takes the house off the market and holds it for him, in 3 months, Joe will buy it for the $100,000, and Joe will pay Bob $5,000 for holding it for him. And if at the end of the 3 months, if Joe doesn't want to buy it, Bob can keep the $5,000, but if Joe does want to buy it, Bob has to sell it to him. So Joe has the option, that's why he had to pay the $5,000, and Bob has the obligation. So in this situation, the $100,000 would be the strike price, the agreed upon price, the 3 months would be the expiration date, and the $5,000 would be the premium. That's the terms of the contract. So a few things can happen. Joe could be right and the value of the house increases. Let's say at the end of the 3 months the value of the house is worth $120,000. This is called having your contract be in the money. The stock price is above the strike price. Or in this case, the value of the house at the end of the 3 months is above the agreed upon purchase price, the $100,000. In this case, Joe would buy the house for the agreed upon $100,000, plus he's out the $5,000 premium, so he's $105,000 all in. But now he owns a $120,000 house. He has a net positive gain of $15,000, but he only really risked $5,000. That's the appeal of buying calls. You can in essence be in control of a high value asset with a proportionally small amount of money. Joe was in control of that $100,000 house, but he only risked $5,000. Bob, on the other hand, is not necessarily upset either. He came out $5,000 ahead of his original position. He just missed out on potential gains from his original position 3 months ago. So he was going to sell it for $100,000. He didn't know what the market would do either. Now, at the end of it, he's got $105,000 total for it, so he's happy as well. Now, the second scenario is the price could go down. Let's say the house is valued at $80,000 at the end of the 3 months. This would be a contract out of the money. The stock price is below the strike price. In this case, Joe would not buy the house. There'd be no reason for him to pay $100,000 for the house when it's only valued at $80,000. And since he has the option to walk away from the deal, that's what he paid the $5,000 for. He would let the contract expire worthless. There's no easy way to say it. He'd lose his $5,000. Unfortunately, this is how it goes a lot of the time. For Bob, he would still be in control of his stock, or in this case the house, and he would get to keep the $5,000. The only other option is the contract expires at the money. The house is worth exactly $100,000 at the end of the 3 months, in which case the option contract just expires. There's no point in exercising the contract, as you can sell or buy the stock from anyone at that price. One other option, or one other thing to note, is that it could, at the end of the 3 months, the house be worth $102,000 or somewhere just a little bit above the original price. So let's say $102,000. In this case, the contract would be in the money. The stock price would be above the strike price. But since Joe already paid $5,000 and he would be paying 100 grand for the house, he would be 105 grand in, so he would still come out at a negative $3,000. So it is possible for your contract to be in the money but still lose out on the deal. Now let's see what it looks like. On an actual trading platform. I got Robinhood pulled up right now, but it should look the same on all the major trading platforms. I just picked a random stock to look at, so we're looking at Tupperware. It's been pretty volatile lately, so I figured this would be a good example to look at. So to get to this screen, you're going to go to Trade and then Trade Options. If you don't see Trade Options, it's because you don't have options trading approved on your account yet. If you're already part of the Theta Gang, just look into Setting Up Options channel. Under the Information tab, we've linked tons of resources on setting up options on all the major trading platforms. If you're not a part of the Theta Gang yet, you're missing out. We've got a great community, a team of analysts, tons of stock market education. We give out options alerts on stocks every day that we buy. So click our link in the description, magnumopustrades.com, and sign up. Once you've done that and you get to this options screen, there's a few metrics that you're going to want to look at. So one thing to note right off the bat is that when you buy or sell an options contract, it's for 100 shares. So one contract equals 100 shares. So the first thing you're going to look at is the share price. That's what the stock is trading at right now, $2.83. The next thing you're going to look at is the strike price. So the $3, that is the agreed upon contract price. So that in our example would be the $100,000. So that's what you, the buyer, we're buying the call now, and the seller would agree upon that strike price. At the end of the expiration, we would buy for $3. Now the expiration date I have set for just this Friday. Normally you'd want to go out further than that, but this will work for this example. And the ask price, this 10 cents, is our premium. So that would be the $5,000 from our example earlier. Keep in mind it's for 100 shares, so this is 10 cents a share, so the premium would be $10. So if you were going to buy a call option for the $3 strike price for Tupperware, you would pay a $10 premium, and then at the end of this week on Friday, if the share price is above $3, you would execute and buy 100 shares at $3. If it's below that, you would not execute. So if you remember how I told you earlier how it can technically be in the money but still a losing deal, that's what this break-even price is. You have to, the share price would have to get over $3.08 for you to start getting into the profit, or it's got to increase 8.82%. Now let's look at selling a call. Very similar metrics, still looking at the same thing. You have this 5-cent ask price. So if you're going to sell a call at $3, you would get a $5 premium. If it goes above the $3, then the options contract would be executed at the end of the expiration date, and you would sell your shares for $3. Now one thing that's neat about when you're selling an option, it gives you this chance of profit. This is automatically calculated by Robinhood using the Greeks, which we go into in a later video, so go check that one out if you want to learn about the Greeks in the stock market. But that should be pretty much everything you need to know for buying and selling call options. In our next video, we're going to buy and selling puts, so go check that one out.